This course focuses on introductory managerial/cost accounting topics. These are explored from the perspective of managers doing business in global markets. While the focus of financial accounting is on concepts related to financial statements, the focus of managerial accounting is on concepts related to decision-making. Managerial accounting is a branch of accounting focused on providing information to internal users, primarily managers, so they can make informed decisions about planning, directing, and controlling operations. Unlike financial accounting, which is designed for external stakeholders such as investors, regulators, and creditors, managerial accounting is more flexible and tailored to the specific needs of the organization. Managerial accounting focuses on internal decision-making. It provides detailed financial and operational information to managers to help with planning, controlling, and evaluating business activities. This type of accounting is forward-looking, often involving budgets, forecasts, and performance metrics tailored to specific departments or projects. It is not regulated by external standards and is customized to meet internal needs. Financial accounting, on the other hand, is designed for external stakeholders such as investors, creditors, and regulators. It involves the preparation of standardized financial statements, including the balance sheet, income statement, and cash flow statement, that reflect the historical performance of the company. Financial accounting must comply with established standards like GAAP or IFRS and emphasizes accuracy, consistency, and transparency. Managers rely on accounting information to fulfill three key responsibilities: planning, directing, and controlling. Planning involves setting goals and determining how to achieve them. Directing refers to overseeing day-to-day operations, and controlling involves evaluating performance and making adjustments. Managerial accounting supports all three functions by providing detailed, actionable data. Stockholders elect a board of directors to oversee the company. The board meets only periodically, so it hires a chief executive officer, CEO, to manage the company on a daily basis. The CEO hires other executives to run various aspects of the organization, including the Chief Operating Officer, COO, and the Chief Financial Officer, CFO. The COO is responsible for the company's operations, such as research and development, R&D, production, and distribution. The CFO is responsible for all of the company's financial concerns. The treasurer and the controller report directly to the CFO. The treasurer is primarily responsible for raising capital, through issuing stocks and bonds, and investing funds. The controller is usually responsible for general financial accounting, managerial accounting, and tax reporting. The New York Stock Exchange requires that listed companies have an internal audit function. The role of the internal audit function is to ensure that the company's internal controls and risk management policies are functioning properly. The internal audit department reports directly to a subcommittee of the board of directors called the Audit Committee. The Audit Committee oversees the internal audit function as well as the annual audit of the financial statements by independent CPAs. Cost classification serves several key purposes. It helps assign costs to specific cost objects, anything managers want to measure separately, supports cost accounting and manufacturing, aids in preparing financial statements, predicts how costs behave with changes in activity, and informs managerial decision-making. Assigning a cost means directly identifying and attaching a cost to a specific cost object, e.g., a product, department, or project. This is a precise and traceable linkage. Allocating a cost refers to distributing a cost across multiple cost objects, often using estimates or formulas. It is less precise, typically used when direct assignment isn't feasible, e.g., allocating utility costs across departments. In accounting, costs are categorized based on how easily they can be traced to a product or cost object. Direct costs are those that can be easily and conveniently traced, such as direct materials and direct labor used in production. In contrast, indirect costs cannot be directly traced to a specific product. A common example is manufacturing overhead, which supports production but isn't tied to one item. Lastly, common costs are a subset of indirect costs that support multiple cost objects but cannot be attributed to any single one. These distinctions are essential for accurate cost allocation and financial analysis. In manufacturing, product costs include three key components. Direct materials are the raw inputs that become part of the final product. Direct labor refers to the workers who transform those materials into finished goods. Lastly, manufacturing overhead covers all other production costs that aren't directly tied to materials or labor, such as utilities and equipment maintenance. Manufacturing overhead includes all indirect costs in production that aren't direct materials or direct labor. This covers indirect materials, which can't be easily traced to specific units, indirect labor, such as support staff in the plant, and other costs like utilities, depreciation, and repairs. These expenses support production but aren't directly tied to individual products. Non-manufacturing costs include expenses not directly tied to production. Selling costs cover activities like securing customer orders and delivering products and can be direct or indirect. Administrative costs relate to managing the organization and also vary between direct and indirect. These costs support business operations beyond the factory floor. Product costs are all expenses related to acquiring or making a product. These costs attach to each unit during production or purchase and remain with the product while it's held in inventory, only becoming expenses once the product is sold. When direct materials are used in production, their associated costs are transferred from the raw materials inventory to the work in process inventory. To convert these materials into finished goods, direct labor and manufacturing overhead costs are added to the work in process inventory. Once the production of goods is complete, the total costs are transferred from work in process to the finished goods inventory. Finally, when the finished goods are sold to customers, their costs are transferred from the finished goods inventory to the cost of goods sold account. Manufacturing companies manage three key types of inventory. First, raw materials. These are the basic components that go into making the final product. Next, work-in-process inventory. These are items that are partially completed and still undergoing production. Finally, finished goods. These are fully completed products, ready for sale but not yet delivered to customers. Together, these inventories represent the flow of materials through the manufacturing process. Inventoriable product costs are limited to production or purchase costs and are recorded as inventory until the product is sold, then they become cost of goods sold. Costs from other stages of the value chain, like R&D, design, marketing, distribution, and customer service, are expensed in the period incurred and are called period costs. Under GAAP, only production-related costs can be included in inventory or cost of goods sold for external reporting. Cost behavior refers to how costs respond to changes in activity levels. Variable costs remain constant per unit but change in total as activity increases or decreases. Fixed costs remain constant in total within a relevant range, but the cost per unit decreases as activity increases. Mixed costs include both variable and fixed components, meaning they partially change with activity while also maintaining a fixed portion. An activity base is a measure that drives the incurrence of a variable cost. Common examples of activity bases include units produced, machine hours, miles driven, and labor hours. As these activity levels change, the associated variable costs change proportionally. Committed fixed costs are long-term expenses that cannot be significantly reduced in the short term. These costs are typically tied to foundational operations, such as facility leases or salaried personnel. Discretionary fixed costs, on the other hand, can be adjusted or eliminated in the short term based on current managerial decisions. Examples include advertising, training programs, or research initiatives. The relevant range of activity for a fixed cost refers to the span of activity levels within which the total fixed cost remains unchanged. On a graph, this is represented by a flat horizontal line, indicating that the cost does not increase or decrease as activity varies within that range. Variable costs change in total with activity levels but remain constant per unit. Fixed costs stay the same in total within the relevant range, while the cost per unit decreases as activity increases and as activity decreases. A mixed cost includes both fixed and variable components. For example, a utility bill often has a fixed monthly charge plus a variable charge based on usage. This means part of the cost remains constant regardless of activity, while the other part increases or decreases with usage levels. The total mixed cost can be expressed using the equation y equals a plus bx, where y represents the total mixed cost, a is the total fixed cost, the vertical intercept of the cost line, b is the variable cost per unit of activity, the slope of the line, and x is the level of activity. This equation shows how mixed costs combine a fixed base with a variable component that changes with activity. An example of mixed cost. Decision-making involves selecting alternatives by focusing on relevant costs and revenues. When making business decisions, the primary goal is to distinguish between relevant and irrelevant costs. Relevant costs are those that will change depending on the decision made, such as differential costs and revenues. Irrelevant costs, like sunk costs, have already been incurred and will not be affected by future choices. Identifying which costs matter helps managers make informed, effective decisions. Differential cost, or incremental cost, is the difference in cost between two options, while differential revenue is the difference in revenue. Both are always relevant to decisions and may include fixed or variable costs. Sunk costs, which have already been incurred and cannot be changed, should be ignored in decision-making. Opportunity cost is the potential benefit that is lost when one alternative is chosen over another. These costs are not recorded in accounting systems but must be considered in decision-making. For example, when a student chooses to attend class, the opportunity cost might be the income they could have earned by working during that time or the leisure they gave up. The traditional income statement organizes costs by function, separating cost of goods sold from selling and administrative expenses to calculate gross margin. It is primarily used for external financial reporting. In contrast, the contribution margin income statement classifies costs by behavior, separating variable expenses from fixed expenses to calculate contribution margin, which helps managers analyze how changes in sales affect profitability. While both formats arrive at the same net operating income, the contribution format provides clearer insight into internal decision-making.